those of you who haven't listened to one of these online sessions before, pre-recorded. This is a recording of a live class which is being done Monday night, and this is for part 8 of Fundamentals of Income Tax for people in the British Columbia region or wanting to view British Columbia related content. And we are going to be looking in part 8 at chapter 7 of the main textbook, Fundamentals of Income Tax. All right, so welcome back, everyone. My students are just back from the weekend and wrestling with the last chapter review problem, so we will see how many questions they have. As always, guys, if you get booted out of the room or anything like that, any kind of internet interruption, keep in mind these steps just to get yourself logged back in. If you're having trouble with audio, including clicking yes when WebEx prompts you to. WebEx is a little bit temperamental. I was having some issues yesterday with my class with my new headset, so guys in the chat, do let me know if my sound cuts out. I suspect it might be something as simple as nudging my headphone jack or anything like that, but you all can hear me right now, I think, so let's get into it. I see a nice bunch of green check marks in the participants list. All right, as always, questions are very much encouraged, and for those of you listening live, remember, if there's anything that's unclear or you'd like more clarification about, please ask, because as I always say, if you have a question, if something's unclear to you, it's probably unclear to someone else as well. And the people listening after the fact won't be able to ask questions. So we are going to, as always, respect our class times, so we'll be running for 3 hours, and we are not going to run much past 9 unless we are in the middle of some crucial point. That said, we are going to be speaking about your first assignment at the end of class tonight, so I'll be happy to deal with all of your questions about that, however long it might take. All right, in our last class, we looked at chapter 6 of the textbook, which is where we first started to move beyond simple things, basic things, to deal with employment-related scenarios. So we started to look at some slightly different types of income that is reported on different kinds of slips, such as the T507, the T4AP, and T4E. Broadly speaking, we were looking at social benefits and related types of income last time, and sometimes it's necessary to repay social benefits. In the case of EI, sometimes you receive too much EI during the year due to a mistake by the EI people or on your end or on your employer's end, and some EI is repaid during the year. As EI is also intended as a short-term semi-emergency measure because you've lost a job or what have you, sometimes when you get to the end of the year and your income has been over a certain amount for the entire year, the government will then require you to repay some of the EI because the short-term emergency is over and now you can afford to pay them back the EI that you didn't really need when over the time period of a year. We also looked at the non-refundable tax credit, which is available for charitable donations, and how that differs from political contributions. Donations in particular are calculated on the Schedule 9, as we're going to see when we look at the chapter review problem from last time. And we looked at the refundable tax credit known as the Canada Workers Benefit, and how it is when you receive it, it will generally also result in you receiving an advance payment on what the CRA estimates to be your Canada Workers Benefit for next year, and this is referred to as the Advanced Canada Workers Benefit. All right, guys, did you have any general questions about last time before we look at the chapter review problem? All right, if not, let's get into the chapter review problem, and questions may arise from that. Okay, so chapter review problem 6-1. Let's have a look at that. So this is for Andy Van Holt, who is single and lives on Queen Street in your city. And here's what we know about Andy. So he made a federal political contribution of $125 to the Federal Liberal Party, for which he has an official receipt. He began the year on EI as there was a shortage of work at his employer's place of business. This was Andy's first time on EI, and he was recalled by his employer in late July. But unfortunately for Andy, he had an injury on the job, and as a result, during the last part of the year, received workers' compensation payments. So for Andy, we have a T4E, a T4, and a T507, all of which are reproduced below. He also received $5,300 in tips throughout the year and made some donations, and we've got receipts for these here. As well, last year when his grandfather died, Andy inherited his coin collection and $5,000 in cash, and the value of the coin collection was estimated at $15,000. So we now know how to complete a complete tax return for someone. So the assignment here was to complete a tax return for Andy. Bearing in mind he's a Canadian citizen, wants to answer yes to the Elections Canada question, does not want to register for online mail, and he does not own any foreign property, and lived within a CMA. He does not want to make additional CPP contributions for his tips. And here we have his T4E, his T507, and the T4. And I've mentioned this before, but for anyone online who may have missed this, the box 22 is not actually blank. The value for box 22 should be taken from these provincial numbers down here, because it will vary slightly by province. The idea being to give all provinces a roughly similar tax return, even though the result will not, say, match to the penny. All right, so again, we've given you a checklist to follow as you work through. So read the problem, confirm the personal information for page 1, next confirm the answers to page 2, then analyze the entire problem, what needs to go on the return and what can be left off, what income is required to be reported, what deductions can be reported on the tax return, and does the tax result make sense? Can you explain the reason for the balance due for the refund, and what tax tips would you suggest? So let's have a look at those questions then. All right, students, so please let me know. So first, how does Andy treat his inheritance money? Right, he should enjoy it. I think his relative would want him to, absolutely. But he does not need to declare the $5,000 at all, right? He doesn't need to report it on the tax return at this time. Now, it's important to note, though, and we're going to see this principle come up again, that if he invests that money and that generates income in the future, that income would be taxable. And if he sells the coin collection in the future and he sells it for more than its current assessed value, that might have to be reported in the future. But we're going to talk more about that a little bit later. But he doesn't need to report anything right now. How does he have, what does he have to do with his tips? How are they reported? Do you guys remember? This is other employment income. It goes on line 10400, and he has the option, although he doesn't want to, but he does have the option to make additional Canada Pension Plan payments, contributions based on this income from his tips. Now, what donations can he claim on Schedule 9? So let's have a look at that list of donations again. All right, so WebEx drops its tab down right there. Okay, so let's have a look at that. So the list of donations, well, let's go through one by one. Salvation Army, can he claim that? Very good. It's a registered Canadian charity. And as we talked about last time, if you're ever in doubt about a charity, you can look this up online. There is a list of registered Canadian charities that you can access through the CRA. Okay, and he should have the receipts confirming the donation. Now, notice that it specifies here that he has the following donation receipts for 2024. All right, what about the Red Cross? Good. Again, another registered charity. We don't even need to look that one up. How about tickets for a 50-50 raffle? In this case, the answer is probably no. The raffle itself, the lottery itself, would be like buying a lottery ticket. This would only be claimable, A, if the local soup kitchen is a registered charity, and B, an amount of a donation was entered over and above the cost of the tickets, and there's no indication that's the case here. So things like the home lottery that BC Children's Hospital does, if you purchase one of those lottery tickets, when you get that, I believe anyway, I haven't bought a ticket in a while, but I believe then the amount of the donation is separated out from the value of the lottery ticket itself. So in this case, for a 50-50 raffle, 50-50 raffles, famously, all of the proceeds, 50% goes to the organization and 50% to the winner. So, all right, a donation to the Alzheimer's Society. What about that one? Good, exactly. And how about your local church? Yes, good. Most local churches are registered charities and would have a registered charity number. So if in doubt, look at the receipt closely, and they should have the charity registration number on there, right? Key thing is a canceled check is not sufficient proof. A Visa statement is not sufficient proof. You either need the official receipt with the registration number on it from the charity, or if there's an amount on the T4. Now, when we look at the T4, there's an amount in box 46 indicating the charitable donations were made through work, so that would also be claimable. So $87 there can be claimed. If the receipt is lost, then you can request another one from the organization. Some organizations are set up to issue a duplicate receipt and some are not. I definitely have seen the case where clients will bring in a duplicate receipt because they can't keep track of all of their charitable receipts. People who donate to charity tend to donate a lot to a lot of different charities, so I do occasionally see duplicate receipts. So certainly some organizations will issue a duplicate receipt. But if the organization is not set up to issue a second receipt, then the person may be out of luck. All right, let's look at our last question here. Mohammed has a question about out of foreign donations. All right, guys, what do we remember about foreign donations that we talked about last time? You can claim them, but the number is very small. There are special rules for U.S. charities. For ones that are not in the U.S., however, it's a very limited number. All right, now do we have the link in here? As I've got Chapter 6 right in front of me here, including an example, Schedule 9. We're going to look at the Schedule 9 for the solution. And so the rules are, you can claim foreign donations if it's to the United Nations and its agencies, or registered universities outside Canada. These may or may not have the word university in the name, which ordinarily includes students from Canada and their student body. and foreign charitable organizations to which the Government of Canada has made a gift. Right, and we have links to them in the textbook. As you can see, for foreign charitable charities, there are currently only 2. So this, and they are registered only for a certain period. So there are other charities which have been on the list in the past, so as you can see down here, but at any given time, the list of the recipients is going to be fairly short. So right now there's only 2, the Aga Khan Foundation and the Council for Canadian American Relations. The United Nations, however, is always claimable. Right, but in this case, we don't need to worry about anything like that. And as for U.S. charities, the main thing to remember there is that the main categories are for students who attend a U.S. university or someone in their family attends a U.S. university. Donations to that university are normally claimable. For commuters who live in Canada and work in the United States, they can claim U.S. registered charities, but only against their, but the income limit is based on their world income, and the majority of their income needs to be from the United States. And lastly, if in the case of someone who has U.S. income, and as we'll see today, many people with investments may have U.S. income, you can claim U.S. charities, but only to the extent you have U.S. income. All right, and there's much more detail about all of this in the textbook. Well, that's a good question, Beanish. If he inherited Bitcoin, which essentially is a kind of commodity stock, that's what it is. What matters is the value at the time he inherits it. What he actually sells it for is a different matter. But at the time he inherits it, it is 5,000, and it does not need to be. It doesn't need to be declared on the tax return. Only at the time it is sold does that become something which needs to be declared. All right, and our last question here: where can Andy claim his contribution to the Liberal Party, and is he subject to the EI clawback? So does anyone remember the line that we claim federal political contributions on? Good, 40900. And Muhammad is asking if you inherit a foreign asset above 100K, again, it's still not treated as income. You may then need to file a T1135, but that is not a tax filing. It is a declaration of assets. So, yeah, it would be treated the same as any other foreign asset that you required. You have to report to the government that you've acquired it and if it had any income. And we'll talk about that a bit more today. Now, does anyone think Andy is going to be subject to EI clawback? That's right. His overall income for the year is low enough. He's not going to be subject to any clawback, for one thing. And when we look at his, are you Andy? There you are. And when we look at his T4E, I may have pointed this out to you last time, but for those of you just watching for the first time, we can also see that there is nothing in box 15. So whatever these benefits were he received, they are not treated as box 15 regular benefits, and those are the only benefits which are subject to the clawback. Also, the repayment rate is 0%, so they are also not subject to this type of repayment. And again, we just refer to this as a clawback because you're needing to pay back something that you've already received, and to distinguish this from the other type of EI repayment when the repayment has already taken place at source within the year. Okay, so let's have a look at Andy's solution then. So for his T1, all right, the entries on the first page, fairly straightforward. And he is single. We do not put in an email address because he does not want to sign up for CRA mail. Yes to the Elections Canada question because he is a citizen and wants to update the voters list, and no to the foreign property question because he doesn't have any assets outside the country, and what he inherited is A, inside the country, and B, less than 100,000 Canadian. All right, looking at the entries in step 2 for total income, we can see that his employment income from the T4 slip is entered up here, 14,400. His tips are entered down here, other employment income, 5,300, and then his EI benefits are entered down here on line 11900 of 8,000. So the inheritance doesn't have to be reported. There's no other income to go in here. So his total income is 27,700. Then his social benefits come in down here. In this case, workers' compensation benefits of 4,100. These are added in here on line 34. So his total income then is 31,800. And again, notice that these are totaled together with any social assistance payments or federal supplements, and all of these are totaled together on line 14700. It is uncommon for someone to receive more than one of these types of benefits at once, but by no means impossible. Okay, now we look at the deductions. So in step 3, there's no union dues present, there's no employer pension plan, so the only deduction here is going to be the deduction for CPP enhanced contributions of $109. And again, that is the pensionable earnings from the T4 minus 3,500 gives us the amount which is subject to enhanced contributions. So 1% of that would be $109. So that is then deducted to give us a slightly lower net income of 31,691. There is no EI clawback. Again, the amount is less than 79,000, so no EI clawback needs to be calculated. So the net income remains at 31,691. And then the social benefits from line 14700, 4,100 are entered here because they are deducted. So the WCB benefits are included in net income, which in many cases is going to be beneficial as it increases someone's eligibility for the GST payment, but they are not taxable, so they are deducted from net income to give a lower taxable income. So the taxable income is only 27,591. All right, any questions so far, guys? All good? Sorry, Mohammed, I don't understand. The figures... 109.55. Okay, well, we'll look at Schedule 8 and see how they came to that. Schedule 8 is further down the page. All right, so the taxable income, 27,591. So we calculate the tax on that. 15% of that is 4138.65. And then that's going to be put down on line 124 further down the page. So 124 further down here, 4138.65. Then we calculate the non-refundable tax credits. So first is the basic personal amount of 15,705. carries forward to the top of the next page. Then the standard credits, so the CPP contributions from Schedule 8, which we calculate as $539.55. The EI premiums, $239.04. And the Canada Employment Out, $14.33. So this gives us $2211.59 for a total of $17,916.59 tax credits before we apply the charitable donations. So $17,916.59 times 15% give us $2687.49. Charitable donations, and remember from last time, your first 200 give you credit at 15%, and anything above that give you credit at 29% or 33%. In this case, the Schedule 9 result is 53.23. So for a total non-refundable tax credits of $2742.72. All right, so let's have a look at the Schedule 8 and the Schedule 9. Karina, yes. What is going on over here? What's going on over here is medical expenses. And there aren't any in this problem. And we're going to talk about those in a future chapter. But just to let you know what you're looking at, generally, in a given year, the CRA, the government, considers medical expenses of less than 3% of your net income to be kind of normal. So if your medical expenses are lower than 3% of your net income from line 23600, then you can't claim anything. So in this case, if he had had medical expenses higher than $950.73, he would be able to claim the medical expenses over that amount as a tax credit, right? In this case, he doesn't have any, so the tax credit claimed is 0, but that's why we have this 3% calculation. Yes, Valerie, but we're going to talk about this in a future chapter, to be clear. But yes, you, your spouse, your minor children can combine your medical expenses, and one person can claim them. So the idea, the name of the game, is to maximize the amount of medical expenses that one person is claiming in a given year. All right, the 5523 is for the charitable donations, and we're going to show you Schedule 9 where that's calculated momentarily. All right. So let's first jump down to Schedule 8 for the CPP. Have a look at that. Let's put your chat window back here. There we are. Okay, so remember with the Schedule 8, the first couple pages aren't going to be applicable in many cases. The first page is basically instructions. The second page is for elections. The third page is for the number of months that CPP applies to. In this case, it's 12 months, so the amounts are going to be for the full year, so there's no proration going on. In other words, down at the bottom of the page, the maximums are the normal maximums, and the exemption is the normal exemption of $3,500. All right, so let's look at the CPP contributions calculation. So again, for anyone who hasn't seen this before, the form can be a little overwhelming, the modern form, but it kind of goes step by step. So first, we figure out the total pensionable earnings from all T slips, T4 slips, in this case 14,400. This is less than the 68,500 threshold, so there's no CPP2. That 14,400 minus 3,500 gives us 10,900. So that is the CPP pensionable amount. All right, so here is what actually was withheld and showed up on the T4, and this is what should have been withheld. So first, let's look at what actually was withheld. All right, so the actual contributions were $792.72. That's the amount in box 16. So we're going to break that apart into the base contribution and the enhanced contribution. So we're going to, so this here is 5.95%, and we break it apart into the 4.95% and the 1%. That's what this ratio represents. So this 792.72 means there was a base contribution of 659.49 and an enhanced contribution of 133.23. Then we look at what actually should have been deducted, and 10,900 times 4.95% is 539.55, and the enhanced contribution should be 1% of that, or $109. Okay, so this is an overpayment, we can see. All right, so in the case of an overpayment, essentially what's going to happen is that these numbers are what's going to be claimed on the return, and anything over and above these numbers will come back as a refundable tax credit. So we take the amount here, the 659.49, and deduct the amount that should have been taken off there to give us part of the overpayment. We take the 133.23, deduct the 109 to give us the rest of the overpayment. So the total overpayment is 144.17. And so on this page here, it tells us what to do with everything. So the overpayment of 144.17 will be a refundable tax credit on line 44800. The required base contributions 539.55 are claimed on line 30800, and the $109 is entered on line 22215 as a deduction. So that's Schedule 8. Now let's look at Schedule 9. Or Schedule 9. And as you can see, the Schedule 8 is longer because it has to have sections for self-employment and more complex situations and things like that, none of which we have to deal with in this course, but that's why it's such a long form. All right, so for the donations and gifts, when we total up all the donations and the gifts, and notice on Schedule 9 there is no space to itemize the individual donations, at least in this form. Some software-generated forms may automatically generate a list. But if we add up the charitable donations plus the amount from the T4, this gives us $287. All right. Now, Schedule 9 again looks a bit more complex than it actually is, because it has to single out certain special kinds of donations that have slightly different rules. And this section here is to calculate the maximum donations limit of, in this case, 75% of the income would be $23,768.25. Obviously, he's not coming anywhere near that. So for most people, that's going to be academic. So, but this does mean the entire amount of charitable donations are allowable. So that's $287. $200 of that will receive credit at 15%, or $30, and the remaining $87 receives credit at 29%, or $25.23, giving us a total donations credit of $55.23. Okay, all clear, everybody? All right. Now, last couple of things we want to look at here. Yeah, this will be faster if I do that. Right, so we take the total non-refundable tax credits, $2742.72, the tax on the taxable income minus the credit on the tax credits, $4138.65. Let's make that a little bigger. All right, so $4138.65 minus $2742.72 gives us federal tax of $1395.93. The political contribution comes in now. So $125 is the raw contribution. That goes in line 40900 for information purposes. 75% of that, in this case, because it's below the threshold, it's all at 75%. 93.75 is a credit, and this additional credit is also deducted to give us our net federal tax of 1302.18. This transfers to step 6 and our total payable, and we have provincial tax of 410.19. So this comes from the provincial form 428. Let's jump down to that so you can see that. So for the 428, again, and you guys know this, but for anyone online who hasn't heard this before, remember the provincial form 28 is just a parallel calculation which mirrors step 5 of the federal return. So we take the federal amount for taxable income, $27,591. We drop it into the applicable provincial tax bracket column, which in this case is the bottom tax bracket. So it is taxed at 5.06%, giving us provincial tax of $1396.10. We then look at the provincial tax credits. In British Columbia, the basic personal amount is $12,500. The CPP and EI contributions numbers come over from the federal return, $539.55, $239.04, for a total of $778.59. Again, notice there is no Canada employment amount. So the total BC tax credit is $13,358.59. The tax credit for that is multiplied by the bottom British Columbia tax rate of 5.06%, giving us $275.94. The British Columbia donations credit comes in now, and it is $24.74. That is calculated on the BC 428 worksheet. So the total British Columbia non-refundable tax credits are $700.68. The tax minus this credit gives us provincial tax of $695.42, but the British Columbia provincial tax is going to be then reduced by the British Columbia tax reduction. So that is $547 for incomes that are under $24,338. In this case, the income is over this by $73.53, so it's going to reduce the reduction accordingly. He'll get about half of the reduction, so $285.23 is deducted from his taxes from the reduction. So sorry, $261.77 is deducted from the $547 to give the net reduction of $285.23. So the tax, $695.42 minus $285.23 gives $410.19, and that is the British Columbia tax, which is carried through to line 42800. The British Columbia worksheet for charitable donations, we can have a look at that quickly, but as you can see, it's not as complex as the federal Schedule 9, but you can see it follows the same basic pattern. So $200 gets credit at the bottom BC tax rate of 5.06%, and the remaining $87 gets credit at the second highest BC tax rate of 16.8%. So that's $14.62 plus $10.12 gives a total donations, provincial donations credit of $24.74. As we'll see when we talk about dividend tax credits later, provincial credit rates will often follow the pattern of federal ones, but the rates may be different. All right. Almost lastly, now let's look at, so we've calculated all the way through to total payable. So the total payable is $1712.37. Now we're going to look at his refundable tax credits. So in this case, he had income tax deducted of $2484.99. So that would be income tax taken off from the EI as well as the T4. There's that overpayment for CTP of $144.17. and then the Canada Workers Benefit of $758.70. So total credits of $33.87.86 for a refund of $1675.49. The Canada Workers Benefit, let's have a look at Schedule 6 to see how that's calculated. And again, the first page is mainly instructions for people who haven't taken this course. And the second page indicates whether someone has an eligible dependent or an eligible spouse, if anyone is disabled, and are they claiming the basic Canada Workers Benefit, which they are. So in this case, he has employment income and his other employment income. The total working income is $19,700, but his net income is $31,691. The net income is, get back here. The net income is low enough that he is under the threshold to be able to claim the basic Canada Workers Benefit, and so the calculation will be done on the following page. If he's above this threshold, the calculation will come out to 0, so you don't need to worry about it. So first, the benefit is calculated. So the working income over $3,000, that is, you need a minimum of $3,000 of working income in order to qualify for this. The working income over $3,000 is $16,700. 27% of that is $45.09. This is higher than the maximum benefit, so he simply gets the maximum benefit of $1,590. However, this will then be reduced by his income over $26,149. So that is $55.42. 15% of that is $831.30. So the $1,590 is reduced by $831.30. So his benefit ends up being $758.70. And that is the amount which carries to line 45300. And because he did not receive Canada Workers Benefit in the previous year, he doesn't have to worry about deducting anything online for the advanced Canada Workers Benefit. All right, we covered that kind of briskly, but you guys doing okay? Any questions? All right, we do have a fair amount of material to cover today, so I'm happy to explain anything if it's unclear. Yes, Grant. Yes, we're recording everything. You can go back if there's any issue. Absolutely, absolutely. And those of you listening at home, if you need to listen to something twice, it's perfectly fine. It's also fine to skip ahead if you've already covered this. I guess I should have said that up front. Sorry. I do try to mention that you can skip ahead if you've already heard something. Okay, so for Andy, then, we want you to think in terms of questions a bit. There we go. So if we were to explain to Andy why he doesn't have to pay something back for EI, we would give him the reasons already discussed. His repayment rate is 0. His total income is much less than the threshold of around $79,000. And he doesn't have any benefits in box 15, so they're not regular benefits. I know, Gurjinder, it's mainly because there's a lot of it in Andy's return. Andy's return has a lot of moving parts, but all of the individual parts are relatively simple. Andy's tax return results in a refund. Can you explain why? So here, what are the main components of his refund? Right, the Canada Workers Benefits, that's a big part of it. His CPP overpayment, that's another big part of it. And while he does have charitable donations contributing to the refund, they are relatively small. So, and he's got the political donations as well. Often when we're looking at whether something, and the WCB is not taxable as well, right? So his taxable income is relatively low, and the EI and the T4 both had tax withheld at a reasonable rate. when we analyze taxes in the offices, we often want to look at, is the refund more than, or a balance owing for that matter, is it more than a few $100s? And, so there should be something causing a large refund. Large refunds or large balances owing don't just happen. So in a case like this, there's a lot of contributing factors. The political donation, the political contribution, and the charitable donations, relatively small, but the Canada Workers Benefit is a big contributor for sure, and the CPP overpayment as well, quite significant. And is he going to receive the Advanced Canada Workers Benefit? What do you think, guys? No? Mhm. Some confusion. Let's have a look at what it says in the textbook. Okay? So for the Canada Workers Benefit, the Advanced Canada Workers Benefit, the advanced payments, right? Essentially, they are, if you are entitled to the CWE in a year, the government will make advance payments of based on that for the upcoming year, right? So it does say the estimated Canada Workers Benefit, but the estimate is based on the amount for the current year, right? So there's no more complicated calculation than that. So in this case, so his Canada Workers Benefit would be $758. So half of that would be paid out as the Canada Workers Benefit. So, and we can do this right here with a little calculator. So 758.70. So divide that by half. So 379.35 would be paid out in 3 payments beginning in July, and then every 3 months. And then the other half of it he would receive at tax time, theoretically, assuming it was the same amount in the upcoming year. So each payment then, so we divide that by 3. Whoop, just by 3. Yep, divide that by 3. So he'd be getting $126.45 every 3 months. Okay. And again, if he doesn't qualify for the Canada Workers Benefit next year because his income is too high, his working income is too low, he ceases to be a resident or what have you, then he is not required to repay these advance payments, and they're not included in income. Again, philosophically, the government's assumption is anyone receiving the Canada's Workers Benefit, by definition, is likely to be working, but having a relatively low to medium income, and thus probably could use the support. So the administrative costs of trying to recover it are it's not worth the trouble to try to recover it. It's simply assume that they got an advance on their tax refund, and the government isn't going to be too concerned about it. Remembering again that the overall amount is going to be per taxpayer, but never going to be more than 1/2 of around $1,500 anyway. So that's a relatively modest. So just a reminder to everybody before we get into things. So your first assignment is going to be due after tonight's class, and you are going to have a good chunk of time to work on that. We will look at the schedule towards the end of class, but in case anyone has to leave early, please remember that this is worth 20% of your final mark. The assignment is due prior to when we review it in our next class, roughly speaking a week from now, at the end of next class. There is more information about it in your learner guide, which you can access through ULearn. I will be reviewing as much of that as possible at the end of class tonight. But again, we just mentioned this up front in case anyone needs to duck out early, because we do sometimes have students who try to say that no one mentioned the assignment to them. Okay, tonight though, the bulk of our time is going to be spent looking at theory. So we're going to be looking at investment income tonight and the various topics which arise from that. And then you're going to be using some of this knowledge in assignment number 1, which is why we say don't start assignment number 1 until after you've talked about chapter 7 in class. So we're going to look at investment income, which comes in different varieties. Next class is not Wednesday. Oh, all heavens, all right. Guys. So, all right, so for us, so we started on September 10th. This is the schedule we use. You can see that the next class is going to be Wednesday, October 15th. So not 2 days from now, but a week and 2 days from now. Okay, so you do have a good chance of time. Right. Yes, it's due on October 14th, as it says here. In practical terms, because when you submit the marks, they are all time stamped. So in practical terms, I will be able, so if you put it in the morning of the 15th, like I don't recommend trying to do it on the 15th, but I don't think ULearn shuts you out at midnight on the 14th or anything like that. I don't recommend doing it at the last minute though, just from a stress point of view. But when you submit your marks, they are time stamped, so it will be obvious to me when you did them. So I will be able to tell when they were submitted. So the key thing is they have to be submitted before we review them in class. All right, but you do have until next week. So there's no class 2 days from now. It's a week and 2 days from now. All right, and we will talk about it at the end of class. Yes, Humaira, you have to submit the answers in one setting, but we will talk about this at the end of the class. I assure you. We will have time at the end of class, but I want to give you the theory that you're going to need to do the assignment first. Okay, so but don't worry, students. I'm not about to throw you in the deep end or anything like that. All right. Okay, so tonight then we're going to talk about investment income, and investment income comes in a few different flavors. So we're going to talk about dividends from taxable Canadian corporations. We're going to talk about interest and other investment income, that is other than dividends. We're going to talk about foreign investment income and how it's treated differently than Canadian investment income, and how it's treated the same. And we're going to talk about a type of investment income which has its own special rules, capital gains. So normally when we talk about investment income, you can use it as kind of an umbrella term which refers to all of this, or you can talk about investment income as opposed to capital gains. And as we'll see, sometimes it's important to make that distinction. We're also going to talk about the reporting requirements when you sell your principal residence, that is a home that you live in. We're going to talk about new rules for property flipping, which is when you sell a home after you have owned it for less than a year, and how that can potentially complicate things. We're going to talk about a concept called attribution, which is very important when we talk about investment. And we're going to talk about deductions that can be related to investments. These are what are referred to as carrying charges, and interest expenses, I like to collectively refer to them as investment expenses. So by the end of tonight, you'll be able to explain how dividends from taxable Canadian corporations are treated on the tax return, how interest and other investment income from Canadian and foreign sources is reported on the tax return, how we report capital gains from information slips, and how we report the disposition of a principal residence on a tax return in order for it to be exempt from capital gains treatment. We're also going to be able to talk about the attribution rules, how they apply in different situations, and how and where we claim investment expenses on the tax return. And then we're going to look at the federal worksheet sections which deal with investment income. So investment income and capital gains used to have two separate schedules. One was the Schedule 4 and one was the Schedule 3. The Schedule 3 is still around. The former Schedule 4 has been incorporated into the federal worksheet. So this is why we refer to sections on the federal worksheet now for the income, the associated deduction, and where applicable, the associated dividend tax credit. Okay, so there are three types of investment income, broadly speaking, that we deal with on the tax return. First is dividend income from dividends from taxable Canadian corporations. These receive favorable tax treatment and they are calculated on the federal worksheet, as we will see. Second is interest income, which is, generally speaking, you can think of it as kind of vanilla, bland, regular investment income. You keep money in a bank account, the bank pays you interest. You own someone's mortgage, they pay you interest. You own a guaranteed investment certificate or some bonds, they pay you interest. That's what we're talking about here. It receives no special tax treatment, but does go on its own line on the tax return. And lastly, capital gains income, which, as we'll see, receives favorable tax treatment in a different way, and capital gains are calculated on Schedule 3. Now, the federal worksheet, again, this used to be on a separate schedule called the Schedule 4. But in order to save paper overall, this has now been incorporated into the federal worksheet. So we use the worksheet to calculate lines 12000 and 12010, referring to taxable amounts of dividends from taxable Canadian corporations. Interest income and other investment income goes in line 12100, and for deductions for investment expenses, these are calculated on line 22100. And if someone has dividends, then there will be a federal dividend tax credit on line 40425. All right, so we'll look at the worksheet a little later. But bear in mind, when we're talking about it, it does have these four separate sections that we refer to. And for anyone who hasn't seen the worksheet up until this point in the course, we will be pulling one up to have a look at it. Right, but first let's talk a bit more about dividends and what they are. So dividends, these are payments made to people who own shares in the corporation. It is, generally speaking, a share of the net profits of the corporation. And this is key because a taxable Canadian corporation has already paid corporate tax. And after it pays the corporate tax, what's left over is paid out to shareholders as a dividend. So, in other words, the dividends have already had tax paid on them. And what the taxpayer receives is the net amount. There's a mechanism in place to account for this so that the taxpayer will get some money back. If they've paid more in corporate tax than they would have paid by just declaring the dividends as income. Now, Canadian corporations are taxed at two different tax rates, and so Canadian corporations which have paid at the higher rate give the maximum dividend tax credit back. These are referred to as eligible dividends. Corporations which have paid tax at the lower rate because they qualify for something called the small business deduction, they therefore give a smaller tax credit back because they paid less tax. These are referred to as other than eligible dividends. So the dividend on the corporation, and they can be reported on a dividend slip. We're going to look at examples of these information slips. or they can be not on a T-slip at all, particularly for smaller corporations or small amounts, individual stocks, things like that. So they're not necessarily going to be on a T-slip. When we look at the T-slips, though, it's important to understand three key terms about dividends. So actual amount, the taxable amount, and the dividend tax credit. The actual amount, simple enough. This is the amount that was actually received by the taxpayer. The taxable amount is the pre-tax amount that the corporation received before it paid corporate tax. This amount is reported as income on the tax return, but because we have to reconstruct it, then the actual amount is multiplied by a higher percentage to make it a larger amount so that we can then apply a tax credit. So in Canada, this process is referred to as grossing up, which I don't like the term. It's not clear enough what it's doing. Essentially, you are turning the net amount, which is the actual amount, into the gross amount. So you're making it larger. And then lastly, based on that larger taxable amount, we then calculate the dividend tax credit by taking a percentage of the taxable amount. And this is a non-refundable tax credit, which is applied in Part C of Step 5 of the federal return, which we pointed out earlier. Now, eligible dividends, remember these are from corporations which paid tax at a higher rate to begin with. Here, again, the actual amount, that's the amount actually received by the taxpayer. That's straightforward. The taxable amount grosses up the actual amount by 38%. So you multiply it by 1.38. And then the dividend tax credit is 15.0198% of the taxable amount. As you can see, that is higher than the lowest federal income tax rate. So this will, in most cases, save you tax over and above the federal tax rate. And this has implications, as we're going to see. For other than eligible dividends, and remember these are dividends from corporations where the corporations paid less tax to begin with. Again, the actual amount is the amount actually received by the taxpayer. To calculate the taxable amount, we gross up the actual amount by 15%, so multiply it by 1.15. And then here the dividend tax credit is we get by multiplying the taxable amount by 9.0301%, which is still a reasonable tax credit, just less than for eligible dividends. All right. We don't have, yeah, there's an example I could go into, but I want to make sure we cover all the material in time. So we'll go into that if we have some time. Right. So let's see what this looks like on a T-slip. So this is a T3 slip. It's one of the three most common slips that are used to report investment income. But right now we're going to focus on where dividends show up on the return. So you can see there are these 6 boxes arranged up here at the upper left. The top 3 are for eligible dividends, and you can see we have a box for the actual amount of eligible dividends, the taxable amount of eligible dividends, and lastly for the dividend tax credit. 49, boxes 49, 50, and 51. The numbers are going to vary from form to form, and they're a little bit apparently arbitrary, so don't worry too much about them at this point. Right, but the key thing is the eligible dividends are listed at the top. Then down here we have the other than eligible dividends, and again they follow the same sequence. The actual amount is on the left, the taxable amount in the middle, and the dividend tax credit is on the right. Now, T3s are typically used to report income from trusts. Mutual funds most commonly, although in rare cases this might also be from an estate or a similar personal trust like that. There's other spaces on here you can see. There's a space for capital gains income, which we'll talk about later, and if the capital gains are eligible for deduction. Other income, so again, that's income on line 13000, just miscellaneous income which doesn't fit anywhere else in the return. So it's not investment income, it's not employment income, it's just other income. And if there are additional things like foreign income, foreign tax paid, things like that, there will be additional information down here in these boxes. These may or may not be income which have to go on the return. All right, so that's a T3 slip. Again, this is for income from mutual funds, trusts, things like that. If you're receiving income instead from a more vanilla, a more bland investment instrument, you'll probably receive income on a T5 slip. This is what banks use. All right, so as you can see, it has a similar arrangement with the eligible dividends across the top and then the other than eligible dividends down here. So first of all, recalling the percentages I mentioned before, let's begin with an actual amount of eligible dividends of $117. So who can tell me what the taxable amount of those eligible dividends should be? So again, remember, we're going to multiply this to give a larger number because we want to gross it up. So we want to take this net amount and calculate what the gross amount of the dividends were before corporate tax was applied. Okay, so good. All right, so times 1.38, and that gives us 161.46. Everyone agrees? Excellent. All right, that is correct. All right, so step one complete. Now let's calculate what the dividend tax credit would be. So remember, the dividend tax credit is a percentage of this amount in box 25. So how much is the dividend tax credit going to be? What the heck? Hang on. Oh dear, oh dear. I need. Hang on. I don't want. Outlook signed me out. It's very unreasonable. I'll pull it back up 1 second. That's. Just pause the recording for a moment, Doreen, if you would, while I sign back in here and punch in my authenticator code. Techno. And participants down here, and right, so there we go. All right, sorry about that, those of you listening online. All right, so from a taxable amount of eligible dividends of 161.46, this will give us a dividend tax credit for eligible dividends of 24.25. Good. So that is 161.46 times 15.0198%. Exactly so, guys. Exactly so, and yeah, good. All right. Now, for other than eligible dividends, though, it's slightly different. So, if we begin with an amount of $217, what would the taxable amount be here? All right. Remember, it's going to be larger than box 10. All right, 249.55. Okay, so good. So it comes out to 249.55, and as we can see, the tax credit for these dividends will be 22.53. All right. Now, other things for the T5 we'll point out on the way by. As I say, T5s are largely for interest paid out for things like bonds, for GICs, term deposits, even your regular bank account. The most common type of income we see here, other than dividends, will be interest from Canadian sources, just interest income. You may occasionally get capital gains dividends, but capital gains are uncommon on a T5. There may also be additional boxes here to watch out for, particularly for foreign income. We'll talk more about that later. And notice the box 27 down here for foreign currency. But in general, on the whole, most of the time, T5s will have interest and dividend income, whereas T3s will tend to have capital gains income and dividend income and not interest income. It's entirely possible for a financial institution or investment house to issue both a T5 and a T3 from a given mutual fund, for example. All right. So are the percentages standard? Yes, Mohammed. The percentages are depend on what type of dividend it is. Okay, and Beanish, we will talk about foreign exchange a little later, Beanish. Hang on to those. Hang on to that thought, because we're going to talk about foreign exchange a little bit, so bring up that question again at that time. Lastly, I want to show you a type of investment slip called the T4PS. Now, the T4PS is, we mentioned this before with employment income, so this is an unusual hybrid slip. The PS stands for profit sharing, and as the name implies, it's a T4, so it has something to do with employment income. T4PSs are for situations where corporations offer a profit sharing plan for their employees, and so for employees working for a large Canadian corporation such as TELUS, they may have dividends. They will again be reported near the top of the slip. So the eligible dividends will be in boxes 31, 31, 30, 31, and 32, and the other than eligible dividends right below it, 24, 25, and 26. Notice with a T4PS, again, you may see some capital gains here. You may see foreign capital gains or foreign income here, but you may also see other employment income, line 10400. So this is an unusual hybrid slip which can have employment income or investment income or capital gains on it. But notice that you typically will not see interest income on this type of slip. All right. Okay, so here are a few other notes for dividends. Now, we use the federal worksheet to calculate the dividend income. So in cases where the amounts are not on a T-slip, it's necessary to calculate it manually. But the worksheet is also used to add up your dividend income from if you have more than one T-slip, and you may well. And it's also used to calculate the dividend tax credit. One thing we want to point out is that foreign dividends are never grossed up. We'll talk more about this in an upcoming slide. Instead, we just enter the actual amount directly on line 12100. They are treated like interest and other investment income. There's also a type of dividend called a patronage allocation, which we'll talk about in a few slides. These are from Canadian corporations which are not taxable, that don't pay corporate tax, as we shall see. So they are treated differently. And lastly, we're going to touch on the special election for spouses, because there are some special rules around spouses and dividends, which we will see. So first, let's look at the federal worksheet. Okay, so in the federal worksheet, and again, if you haven't pulled one up before, let's show you where you can find that. So you can find that in the fillable forms package. The federal worksheet is the first one in the package. It's the 5000-D1, the federal worksheet. There's also a provincial worksheet, which you can find by province, and it is indicated with a W. So the 5010D BCW for worksheet will give you the British Columbia worksheet. The federal worksheet, and again, we haven't talked too much about the federal worksheet, but it has various lines. It has sections to let you make calculations for various lines on the federal return. A lot of components of the worksheet used to be separate schedules that no longer need to be submitted with the return. Instead, you just simply use the worksheet to make the calculations and put the net result on the return. This is the section about dividends and investment income comes right at the front of the worksheet. All right, let's go back to our slide and we'll have a look at the worksheet if we need to. So, go back one slide, there we are. So notice that there's 3 sections here, and that's because on the federal worksheet itself, the other than eligible dividends are separated out, and for information purposes, there's a result on line 12000. The total of all dividends, eligible and other than eligible, is reported as income on line 12000, and this is added in. So we can see it here. So here, the other than eligible dividends from T3 slips, T4 PS slips, T5 slips, and T5013 slips are all added together here, and this amount goes on line 12010. And then the taxable amount of all dividends from all these various slips are totaled together in this section, and then that result goes on 12000, and that is what is added as part of total income. Now, there is a confusing component to this form. So if you were just reading the form and hadn't taken this course, this can trip up people, so I want to point this out. If someone has dividends on an information slip and dividends that are not on an information slip, you need to be a little careful. So this section down here, we calculate dividends if you don't have a information slip. So here you calculate the actual amount of eligible dividends, you multiply that by 138% to give you the taxable amount. And for other than eligible dividends, you multiply that by 115% to give you the taxable amount here. And so both of these are added together to give you the amount for line 12000. And the other than eligible dividends here are calculated here to give you the amount for 12010. Here's the trick. If you have some dividends on T-slips and some dividends that are not on T-slips, then there is no line here to add those things together. You'll notice that here the language is to include this amount in line 12010 and 12000. So this means you need to manually add this amount and this amount, and manually add this amount and this amount, right? But if you're just reading the form quickly, you might not notice that. So I 138%. Mohammed, calm down. The 138%. Remember, that is the same as multiplying it by 1.38, right? Yeah, yeah. So 138% means that we're multiplying it by 1.38. Um, so on an actual taxable eligible dividend, an actual eligible dividend of $1,000 Canadian, we would multiply that by 138%, and that would give us 1,380, for example. Okay. All right. But the key thing is, remember this language about including this amount, right? Because that might not jump out at you if you are doing this manually. All right. Similarly, the dividend tax credits, when we look at those further down on the federal worksheet, here there's a section for information slips again. T3 slips, T4PS slips, T5 slips, T5013 slips. Here, notice we're just adding together the dividend tax credit from all of them. We do not need to separate the other than eligible dividends part for this purpose. So the total is just entered here on line 5. And then for anything where we did not receive an information slip, we multiply it out here. So we figure out the other than eligible amount by taking the amount from line 12000, deducting the amount line 12010, and this amount times 9.0301% gives us the tax credit for the other than eligible dividends, and this amount gives us the tax credit for the eligible dividends. So here, the key thing here, the little footnote you got to notice is that you're only taking the amount from line 12000 and 12010 for dividends that were not shown on an information slip. Right? So again, this can be a little confusing if you're not reading this very carefully. So you should always take care when dealing with a combination of dividends that are from T-slips and not on T-slips as a result. But luckily, again, we do have this line here, unlike previously, so you can just add together the amount from slips and the amount not from slips. The key thing is just make sure you're not adding the same dollar twice. All right, so with all that in mind, let's have a poll question. All right, so keeping all of that in mind, and let's minimize our participant list. So what is the taxable amount of $120 of actual dividends received, assuming they were eligible dividends? Is it $45.60? Is it $141.60? Or is it $165.60? All right, let's set our timer and let's see what you think. Sorry, I thought I clicked to open the poll. Oh, there it is. There it is. There we go. I guess it didn't register my click. I can see everyone seems to like one particular answer. That's good. Oh, you can't, Valerie? Here. Okay, good. Yeah, with the poll, I'm never quite clear if it shows up on your screen in the same position as it's on my screen. So your view is going to be always going to be slightly different from mine. So I want to try to keep things like this chat window that I'm moving over to the side so where it's not blocking anything. Okay, almost everyone has answered. Fantastic. All right, and 100% of you got the correct answer. The correct answer is, of course, C, right? B would be the case if you were talking about other than eligible dividends, and A would be if you'd use 38% instead of 138%. All right, good stuff, everyone. Okay, so I think what we're going to do, we're going to take a 15-minute break, and we'll just have one break tonight because that's a lot of heavy lifting. When we come back, we're going to talk about some other unusual sorts of dividends, and then we're going to talk about capital gains, and in particular things to do with just selling selling your principal residence. Okay, I forgot the word. Okay, good. So welcome back, everyone online. And as one of my students points out, there is a small typo in exercise 7-2 in the textbook. The person's income in that exercise should be 56,000 rather than 55,000. So we'll be updating that by the end of this week. Okay, so we do still have a fair amount of information to cover tonight, though. So let's make sure we cover that. And then at the end of session, we will be talking about the assignment and answering all of my students' questions about that. So, but first, let's talk about patronage allocations. Now, remember I mentioned that when we talk about the dividend tax credit and things like that, it only applies to taxable Canadian corporations. So, certain Canadian corporations do not pay corporate tax in the regular way. Cooperative corporations, in other words. So cooperative corporations issue a type of dividend called a patronage allocation. This is rare in some regions of Canada, but common in others. In British Columbia, the major cooperative organization is Co-op, and it is operating in some of the more rural areas of the province. So for Co-op and similar cooperative corporations, these issue dividends called patronage allocations, and they are reported on a T4A slip in box 30. Now, because these are not subject to the corporate tax the normal way, they do not receive the dividend tax credit, and they are also not grossed up. They are also not treated as income when they are entirely from personal purchases. So if you are a co-op member and you're buying things from the co-op and receiving dividends as a result, then it is not treated as income and does not need to be reported on the return. If, however, you are, for example, running a small business and purchasing supplies for your business through the co-op, then these allocations are treated as income. So if they are taxable, then they are reported on line 13000. Oh, sorry. Humaira, can the rest of you hear me okay? I'm not muted. Okay. So, okay, that's the main thing. All right. Sorry, Humaira. Humaira is operating on a temporary loaner laptop. She's been having some issues, so hopefully that's why we record these sessions. All right, I will keep on as best I can, and let's. What can I do to help her out? Just follow along as best you can. All right, so, and oh, maybe try signing out and back in again. Okay, so once again, patronage allocations, if they're only for personal use, they are not income. So they are not investment income, they are not any kind of income. And if they are treated as income because they're used for business, they are still not investment income, they are other income on line 13000, which as we remember is for miscellaneous income, which doesn't fit into any other category. All right. The other thing we wanted to mention about dividends, well, one of the other things we want to mention about dividends is that there is a provision to have them be reported by your spouse. Remember that the dividend tax credit for eligible dividends is higher than 15%. So this, one of the implications of this is that you are allowed to choose to allocate your spouse's dividends to yourself if this would result in a higher tax credit overall for the spousal amount. Now, we haven't talked about this yet in the course, but essentially the spousal amount, when your spouse's income is below the amount of the basic personal amount, then you can claim their basic personal amount that they're not using. So if by your spouse giving you their dividends, allocating the dividends to you for tax purposes, this would either create or increase the spousal amount. That is, it would drive their income either below the basic personal amount or further below the basic personal amount if it's already there. Then you are allowed to do this. This will be beneficial in most cases. Now, there are some conditions around this. But some things to keep in mind before we, yes, so the key thing is they must allocate all of the dividends to the higher income partner. And this is usually going to be beneficial, but in some cases it may not be. So if the higher income spouse is in a very high income bracket, the additional dividend tax credit may not make up for the additional taxes. And in some cases, the higher net income may result in other benefits being lost. So you need to consider it carefully. The main thing to keep in mind is most tax software packages will do this automatically by default when they optimize the taxes. And if you forget about this provision, it may not be obvious what's going on. So if you are having trouble, so if this comes up and you and a client says, "Hey, what's going on? Why are my dividends going on my spouse's return?" Or why am I getting my spouse's dividends? It's helpful to remember this rule. It saves tax overall. If you are unsure, most software packages will allow you to try the calculations a couple of different ways so you can see if it saves tax by doing the election or not. But as a general rule of thumb, assuming the higher income spouse isn't in one of the very top brackets, typically this will be advantageous if it's possible. All right, we'll talk more about the spousal amount in an upcoming chapter, but that's the basics of it. All right, and Humaira is still having trouble. I think it's on your end, unfortunately. All right. Okay, so for other types of investment income, as we were talking about, interest from a bank account or from bonds or things like this, this is referred to as interest and other investment income, and this is totaled up on the federal worksheet and then entered on line 12100. All of these amounts are totaled up. They're all reported together on line 12100. There's no information line or anything like that. It's pretty straightforward, and this type of investment income doesn't receive any special tax treatment. Now, so capital gains are not included here, and taxable Canadian dividends are not included here, but otherwise, all other Canadian investment income, as well as all foreign investment income, is included here. And again, investment income here as opposed to capital gains income. Interest income can be reported on an information slip, rarely on a T3, normally on a T5, sometimes on a complicated slip called a T5013, which is beyond the scope of this course. It may also be on no slip at all. For example, if you hold a private mortgage or you receive interest income from the CRA, interest on a refund, where the CRA takes some time getting the refund back to you to pay you some interest, that is considered to be interest income for this purpose, as well as foreign slips. Now, it's good to know that sometimes financial institutions won't issue a T5 slip if the amount of interest is very small. Below $50 is the official cutoff. In practice, I have seen slips with much lower amounts than $50 on them. But just because a T-slip isn't issued doesn't mean the interest doesn't have to be reported. Like all income that you receive, the rule is if you have income, it must be reported even if it's small. Now, one unusual thing that we want to point out at this level is a form called a T5008, and this is used to report income from a type of investment vehicle called a treasury bill, or a T-bill for short. What these are bonds issued in very high denominations, often 100,000, 10,000, or $100,000, something like that, and they mature after 90 days. What happens is you purchase them at a discount, and then when they are redeemed, it is for the face value. So, for example, you might purchase a treasury bill for $100,000 for $99,000. So you pay $99,000, and then when 90 days goes up, you're paid $100,000. The T5008, on this form, we report the type of security. So it has to be DOB, debt obligation bearer bonds, I think is what it's short for, or debt obligation bond. And then in box 20 and 21, you have the cost of acquisition and the proceeds of disposition. The difference between these two boxes would be the 99,000 and the 100,000, for example. That difference of $1,000 is reported as interest, not a capital gain. So we calculate interest for these type of bills by subtracting the cost of acquisition from the proceeds of disposition. Normally, the proceeds of disposition will be the same as the face value of the bill. Now, this is what a T5008 looks like. As you can see, it's a relatively complex form. It is often used to report things like stock transactions on it. Box 15 here indicates the type of securities that are involved, SHS for shares, for example. There are 14 different types of investment which can show up on a T5008. Most of them generate capital gains and are beyond the scope of this course. So we need to be very careful when we handle these. At this level, only T-bills are going to be discussed, and because T-bills generate interest income, which is relatively straightforward to handle. Okay, and hang on, Mohammed. All right, so the face amount here, this would be the face value of a T-bill, for example, which is normally what it's going to be settled for in box 21. Here, box 20, the cost or book value, that's what you're going to pay for it. So we're going to touch on this more in a moment, but the tax treatment is very different between interest income and capital gains. So when you deal with the T5008, it's very important you determine what type of security you're dealing with. And if it's capital gains, that's not something you should be handling at this level. In this course, we're only going to talk about very simple examples of T508s, but please don't be misled. These are potentially quite complex if you're encountering this working in the field or in a tax office. For one thing, they often will have a blank value in box 20 and box 21, and then you need to do research or ask further questions and follow things up. So a blank value in this case does not mean zero. It simply means that the investment entity, the investment house, the brokerage, what have you, could not calculate this or did not calculate it. And again, you need to ask additional questions to determine just what's gone on here. All right. And Mohammed is wondering, so you have to report the interest. Yeah, so the interest is going to be the difference between box 20 and box 21. All right, let's look at an example. I think that may help clarify things. So example 7-6 from the textbook. Pull it up here. Yes. Oh, nope, that's British Columbia. There we are. And again, as always, those of you listening online, remember there's always far more information in the textbook than we're able to cover in 3 hours in these classes. So for anything, if you want more detail, if you want to dig into it a little bit more, please look at the textbook. There's more here than I'm able to cover in 3 hours. As good as explaining things as I am, there's just too much information. All right, let's look at illustration 7-6. Oh, and Beanish says, hang on to that thought, Beanish. Let's just finish with the Treasury bill first. Okay, so, but do hang on to that thought. So, in this case, Goldie Baum from an earlier illustration purchased a T-bill for $25,000 for $24,688 in April. So she purchases it in April for less than the face value, and then she receives $25,000 in July when it matures. So the difference between those two numbers is $312, and that is calculated as $25,000 minus $24,688. And she also received interest income from the Royal Bank as shown on the T5 below of $75. Okay, so you can see regular interest transactions on a T5 are very straightforward. The bank just does the calculation. This is how much income you received in the year on your bank account, and it's very common to see T5s from individuals who have bank accounts. Now, Beanish is asking a good question. What about a long-term investment vehicle such as a bond, where you receive interest income every year as well as the face value at maturity? So how are these amounts treated for tax purposes? So the current rule is any interest you receive during the year is reported in your tax for that year. The face value you receive at the end. So this would be a long-term bond other than a T-bill, not reported on a T5008. Essentially, any difference between the face value and the maturity value, which wasn't already included in interest that would be, which wasn't already be reported, would be reported at that time. I haven't encountered that specific issue, but that is that specific scenario, but that is how that would be handled. The key thing is you don't report the same dollar twice, and you would report every dollar of interest income, if possible, in the year when it's received. Now, when we look at This can lead to the difference between the purchase value and the face value. You would report that as interest if that's appropriate. If it is a fixed value, right? You purchased a bond at a discount, that difference itself is interest, and then any interest over and above that difference would also be reported. It's not a capital gains transaction based on what you're telling me, but it would depend on the individual security and the individual rules about it. So it would depend what exactly it was you were dealing with it, but in a case like that, you're purchasing an asset at a discount. So it sounds similar to a T-bill, in other words. But I want to show you something because you've reminded me of something else which can come up. Can I scroll up to the T5008? Hang on a moment. I want to show you something. When we look at the section for interest income, hang on. If I'm about to come to this on a future slide, I'll come back to this. Oh yeah, I am going to. Okay, I'm going to hold that thought. Now let's go back to the T5008. Yeah, Sam, what did you want to see, Sam? Here we are. Coupon in the year. So if someone is receiving interest during the year from a longer term bond, Treasury bills, remember, are typically only for 90 days. If it's a longer term bond, the financial institution should issue a T5 every year with the interest, right? They should. As we'll see, when that doesn't always happen, there are mechanisms which you can follow. We'll talk about that in a couple slides. All right, but before we do, there's one other thing I want to talk about, and that is foreign investment income. Okay, when you have foreign investment income, it's important to remember that foreign dividends are not from taxable Canadian corporations, right? With patronage allocations, they weren't taxable. With foreign dividends, they're not Canadian, so they haven't paid any Canadian tax. So therefore, with foreign dividends, we only ever report the actual amount of dividends from the foreign corporation. Some countries use a similar concept to grossing up, but that value can be ignored. The United States does not, right? And depending on but some countries like the UK, Australia, New Zealand, they use an equivalent of grossing up. Grossing up, as far as I can tell, is a Canadian term. The technical, the economics textbook term for that mechanism is called dividend imputation, and this is sometimes referred to as franking. Regardless of what it's referred to on a foreign information slip, you can ignore anything except the actual amount. Now, interest income from foreign sources could be reported on an information slip if it's as part of a Canadian mutual fund, so it could show up in a box 25 of a T3 or box 15 of a T5. It may be on no slip at all if it's an informal investment where you're receiving payments and the foreign entity isn't issuing an information slip, or the foreign entity may issue an information slip. It all depends on the situation. So in general, any interest or investment income from foreign sources needs to be reported. It doesn't receive any particular special tax treatment in Canada. It's just included with interest income and included in line 12100. Now, it's very important, however, if someone does have a lot of foreign income, it's important to check if the cost of the various investments are more than $100,000 Canadian, because in which case this specified foreign property would mean that the person has to file a T1135. Now, when we're in many cases, the investment won't exceed $100,000. The mere presence of foreign income does not mean that the investment is larger than $100,000. But in many cases, we have to ask. Most investment houses now will issue a form called, or a statement called a statement of a foreign assets reporting statement, or a foreign holdings report, or something like that. And this is normally laid out so that you can tell the total cost value of all foreign assets held outside Canada through this investment house. And if there's more than one investment house involved, you can combine them to see what you need to report. And they will also have it broken down in such a way that you can easily fill out the T1135. If we have time at the end of class, we'll pull up the T1135 again, just so you can have another look at that. Now, when we're talking about foreign property, it's important to note that foreign income has to be reported on the tax return in Canadian dollars. And this is also true for the T1135. Although it has a box for foreign currency, this is only for trusts or corporations. For individuals, you have to report in Canadian dollars. The amounts on most Canadian income slips also have to be in Canadian dollars. So for a T3, for example, you can assume those amounts are in Canadian dollars. T5 slips are a common exception. These can sometimes be in other currencies. So if so, there will be a 3-letter code such as USD for US dollars in box 27. So you want to watch out for a box 27 because that can be subtle. So typically on a T5, you want to say, is there foreign income in box 15? Then look out for a foreign currency code in box 27. Most software will apply the appropriate exchange rate automatically if box 27 on the T5 is correctly entered, but this is easy to overlook. It is relatively uncommon, but do bear in mind, people can have US dollar accounts at Canadian banks, so it's by no means unheard of. This would be a common example of it. Now, when you're selecting the foreign exchange rate, you have to, which applies, you need to use some caution about this and select a rate which is accurate. So historical exchange rates, normally we can look them up at a reputable source such as the Bank of Canada website to see the applicable exchange rate. If the interest income, say, was received relatively evenly through the year, then you can just use the average exchange rate for the entire year. That's fine. If, on the other hand, it's a single transaction on a single day at a single point in the year, it may be appropriate to use the exchange rate which applied on that date. There's more discussion of this in the textbook. Generally, because exchange rates fluctuate, this can complicate capital gains calculations and things like that. Mostly this is beyond the scope of this course, where we're going to look at relatively simple examples. So, interacting, as I just said, if someone has foreign income, they may need to fill out Form T1135. Similarly, if someone is filling out Form T1135, they may have foreign income from that property, so we need to double check with them. If there is income, it should be included on the tax return somewhere. If there is a discrepancy between the T1135 and the tax return, this is a potential problem for the taxpayer. Any income from an asset, which is reported on the return, needs to be on the T1135 and vice versa, in other words. Now, when we enter everything on line 12100, okay, well, let's let you guys jump in, actually. Let's give you a chance. Let's have a little fun here. Guys, I'm going to let you annotate. So we'll just select you all. Okay, and All right, so guys, please point out to me where here would we include the income from foreign sources. Very good. So this goes on line 6. So we total up all the foreign sources, we do the exchange. If necessary, we attach a separate note explaining how everything was calculated. We enter it on line 6 here. What about interest on a CRA refund? Where would this go? Excellent. That goes on line 5. All right. Now, where do royalties go if you receive those? Excellent. That goes on line 8. So royalties are an interesting thing. We don't talk about them much in this course, but depending on what the royalty is, it can be more akin to investment income, in which case it's reported here. Or if it's more like employment income, it'll be on line 10400. If it's more like business income, it'll be on line 13500. So for example, consider the example of an actor. I sometimes do taxes for Canadian actors. So if they are receiving royalties from a previous performance that they did, that's basically employment income they're receiving after the fact. So that goes on line 10400. If, on the other hand, I own a record company and I'm in the business of making money from music and musicians, then the royalties might be more like business income. Or maybe I'm an actor and I am declaring my acting income as business income, then it would be self-employment income. So then line 13500 would be appropriate. But if I'm an investor and I'm buying a record catalog in order to make money off the royalties from these recordings from the past, then it would be more like investment income and it would go here. All right. Now, one thing to note here. So again, you'll notice interest could show up on a T3, a T5, or a T5013. It cannot show up on a T4PS. Now, there's a line here about interest income that you've reported in a previous year, which is included up here, but has already been reported in a previous year. So that might be the case, say, if we had a long-term investment where over a period of years we had been reporting the income received from that investment every year, and then when the investment matured, the investment house issued a T5 with all of the income for all of the years at once as one big lump amount. So in that case, we would deduct anything we had included as income in previous years, and we would deduct that on line 10, which can sometimes happen. Now, technically, investment houses aren't really supposed to do that anymore, but some of them are still following older rules, so you can see that. So in a case like that, if the taxpayer has been reporting the income every year along, every year as they go along, as they should, then they can just deduct all of that previous income. If they haven't been reporting any of it, then they're going to get a big tax bill. All right. Okay, let's pull up a poll question. So, see how you do with this one. See how well you remember. Let's set our time for 1 minute. Okay, so for this one, a taxpayer has a savings account which earned $17.12 in interest in. Does he only have to report this income if they receive a T5 with the income in box 13? Is this true or false? All right, let's see what you think. All right, there we go. All right, and most of you got it correct, I think. Excellent. So let's share that with you. So in this case, the answer is false. They have to report the income whether it's on a T5 or not. Again, investment houses and banks may not issue a T5 if the interest amount is relatively small, although in practice most of them do. But whether a T5 is issued or not, the income should be reported. All right. So we've been talking about interest income and we've been talking about dividends. Now we're going to talk about an entirely different category of investment called capital gains. So typically when we talk about investment income for tax purposes, although capital gains are an investment, capital gains income is treated very differently for tax purposes. So we tend to talk about capital gains income as distinct from investment income. What is a capital gain? Well, when you sell an asset, whether it's a stock or a piece of real estate or a coin collection, you may sell it for more than you pay for it or less than you paid for it. So the sale of an asset then may lead to a capital gain or a loss. The gain or loss is calculated by taking the selling price, that is the proceeds of disposition, and then deducting the cost price, or ACB, adjusted cost base is the technical term for this, and this receives a favorable tax treatment. Do any of you know what the special tax treatment is? All right, and Mohammed is asking, do banks issue T5s for savings account? Yes, they do. Any account which pays interest can potentially generate a T5. Oh, okay, Grant, but can you expand on that? Half what? All right, you're getting close. It's good, Beanish. That's the way to say it. So only 50% of the gain is treated as income, right? Only 50% of the gain is treated as taxable. Right, you got it. You got it. Good job, guys. All right, so the special tax treatment then is that the taxable capital gain is only 50% of the raw gain, and this is obviously much more favorable than regular investment income, where the entire income is treated as taxable. So capital gains income can be reported in box 21 of a T3, box 18 of a T5, box 34 of a T4PS. On a T508 slip, it would be the difference between box 20 and box 21. For most investments that would be on a T508, the difference would be capital gains. Mutual funds are the most common source of capital gains on T-slips that we see, and those are, stock portfolios, investment portfolios that are managed by a trust company of some sort. So I want you to remember this distinction between taxable capital gain and a capital gain, because there may be questions in the assignments on the exam where we're asking about the taxable capital gain for something as opposed to the capital gain for something. So bear in mind the distinction between the two. Taxable capital gain is what it's referred to on the Schedule 3. So on the Schedule 3 is where we calculate capital gains. So we total up all the capital gains from the rest of Schedule 3, and then we multiply it by 50% to produce the total taxable capital gain, or net capital loss. If it's a positive number, it's a taxable capital gain, and that is entered on line 12700 of the return. If it is negative, then it does not show up. It is not entered on the current year return. It can either be carried forward to use on a future return, or for a more advanced class, it can be carried back up to 3 years for a previous year return. Right? So taxable capital gain. The terms gross and net capital gain here We're not going to get into things like expenses and handling fees and things like that at this level. But what is entered on the Schedule 3, we calculate, effectively we're calculating the net capital gain, if you want to think of it that way, but we don't really use that term here. But that gets a little bit more complex than we have time for at this level. So now, when you sell property, it can potentially produce a capital gain. This includes the place where you live. However, there is a special exemption if you're selling the place where you live, and this is called the principal residence exemption. You can designate any property that you live in for all or some of the year as your principal residence for that year, and you can designate it for, if you designate it as a principal residence for all the years you've owned it, or all the years you've owned it minus one, because in a given year, you might sell one principal residence and buy another principal residence and thus be living in two places, right? So you can designate a property as principal residence for either all years you own it or all the years you own it minus one. And if you do so, then that sale of the residence is exempt from capital gains. This is the only situation we're going to look at this level. It is possible to designate something as a principal residence for only some of the years, but that gets complicated fairly quickly. We're not going to touch on that at this level. It is, however, necessary to report the disposition of the principal residence on the tax return. And this has been the case ever since 2016. And the reason being, prior to that year, people would just say, it's my principal residence, it's exempt from capital gains, I don't need to report it. And so there was no real way for the government to check if someone, say, had more than one principal residence in a given year. If there were three houses simultaneously, that they were all being treated as the principal residence, because obviously you can only live in one principal residence at a time in a year. So since 2016, it's been necessary to declare that a dwelling was your principal residence in a given year. This is reported on page 2 of the Schedule 3, and it's a supplementary form called the T2091 is also completed and signed. If it's your principal residence for the entire time you own it, or the entire time minus 1 year, then it is fully exempt from capital gains. And that minus 1 year, always we want it to be a minimum of 1 year. So, you would never put down 0 because of that. Now, the exemption is not allowed if you don't report the sale on the tax return. On the Schedule 3, on page 1, it talks about this. And as you can see, you just tick the first box to designate the property as the principal residence for either all the years it was owned or all the years that you owned it minus 1 year. And this is filled out together with the T2091. All right. Now, we'll have a look at the Schedule 3 in a little bit, and then you can see how that looks on the page. Also on the Schedule 3 on page 2 is a new rule about property flipping. Property flipping is when you buy a housing unit and then sell it within 12 months, presumably for a profit. Now, the government wants to discourage just people speculating on housing units as opposed to other real estate. So in order to tamp down on this, there's a rule that if you hold property less than 12 months and then sell it, it is not treated as a capital gain, it is treated as business income, and the entire amount is taxable. So on page 2 of the Schedule 3 is a question. Did you dispose of a housing unit or right to acquire a housing unit that you own for less than $365,000 consecutive days. If the answer is no, then there's no flipped property. If there's yes, then it could be a flipped property. However, there are situations in life where you have to sell a property relatively quickly due to circumstances outside your control. So, as you can see, this list covers most of the major life events that might apply. So, the death of the taxpayer or a related person joining a household, or some alteration to the number of people in the household, a breakdown of a marriage or common law partnership, or if there's a threat to the personal safety of the taxpayer and they need to flee, if there's serious disability or illness of the taxpayer or related person, if the taxpayer or spouse has to move to a new job at least 40 kilometers closer, not only are they eligible to claim moving expenses, they are also exempt from the flipped property rule, or an involuntary termination of employment, so you lose your job and thus have to sell your house, for example, or you become bankrupt or insolvent, or the property is destroyed due to a natural or man-made disaster. So as you can see, this covers most of the scenarios where someone might involuntarily have to dispose of a property after holding it for only a short time. The right to acquire housing. So this would be an interest in a property, an option to purchase a property that you might sell, something like that, I would think. Perhaps. Let me look into that and see if I can get you some more information about that. It's not going to be on the test or anything, but remind me if I don't get back to you about that next time. It might be in the textbook, but if it isn't, it should be, so I will look into that. A pre-sale right, for example, might be an example. That's possible, but it's not going to be on the test, so don't worry about that part. Okay, now Schedule 3, pages 3 or 4, is where we actually total up our investment assets dispositions. It is split into 2 periods on the Schedule 3, and this is because there was a proposed change in the capital gains inclusion rate. It was going to be going up from 50% to a 2/3 inclusion rate halfway through the year. So it was proposed that the rate was going to go up to 2/3 on June 25th for people holding more than a certain amount of assets. However, this proposed change did not go through. It did not receive royal assent. You may recall last year was an election year that had something to do with it. I think a reasonable observer might include. But regardless, for whatever reason, this change did not go through, but the change was halted too late for the CRA to be able to go and change the form back. So as a result, on the 2024 Schedule 3 only, the dispositions are divided into these 2 periods, which are then added together, but the rate for both periods is still 50%. So it's effectively just just for information purposes only, which isn't going to affect things. But as you can see, you were asking about net capital gain. You'll notice that the proceeds of disposition is the raw amount you receive, but any expenses associated with that are deducted here. And the adjusted cost base would include any expenses with the initial purchase. So thus what we see over here effectively is the net capital gain, to answer that question from before. All right. As you can see, the columns from period 1 and period 2 are simply added together. They are totaled up separately. And capital gains or losses from information slips are brought in here. So T3 slips, those capital gains come in on lines 17599 and 17600. All other slips, they come in 17399 and 17400. The gains or losses are all totaled up, so both columns are totaled up here. The result is brought to line 21. It is multiplied by 50%, and that gives us the taxable capital gain for 2024. All right, let me show you what the Schedule 3 looks like all together then. We've kind of looked at it broken down apart. And Sam was asking about the tax if you own, if you have a principal residence for only some of the years. That is beyond the scope of this course. Essentially, you need to go through and manually calculate what portion of any capital gain happened in years when you weren't using it as principal residence, and what portion happened during years you were using it as a principal residence. As you can see, that can potentially get real complicated really quickly. All right. Okay, but let's look at a Schedule 3. So in your fillable forms package, this is the 5000-S3 right there. And it's for capital gains and losses right here. So again, the first page is mainly instructions, but as you can see, the bottom of page 1 is where you have the principal residence deduction. And it's got some more details here, and it instructs you to complete form T2091 if you are designating something as principal residence. And at this level, you're always going to want to tick the first box designating the property as the principal residence for all years owned or all the years except 1 year. Notice they also explain what's called a deemed disposition. And their explanation here is very good, very clear. This is when you're considered to have sold property even when you did not actually sell it. So for example, when you inherit a house, in that case, the person who formerly owned the house is considered to have sold the house on the day they died, so that when you inherit it at its value as of that day, and will only be responsible for the capital gain after that time. Okay, so disposition is a very useful concept to keep in mind, although we're not going to be getting into that too much in this course. All right, scrolling down in the form. All right. So part 2 is the question about flipped property, and as you can see, it's all right close together there. So if the answer is yes, but you have one of these conditions applying, then you won't be subject to flipped property. And then on the next 2 pages, we have all the different types of investments or assets where you could conceivably see a capital gain, including personal use property, which normally is not subject to capital gain, but it is as you can see, the page 3 and page 4, they mirror each other, and they just reflect period 1 and period 2. In software-generated Schedule 3s, typically they have the ability to add lines to each of these sections, so you can have an individual line for every single stock transaction. If you were filling it out manually, you might put in something here like, for example, C list, and then attach a list because you've only got one space there. And again, you total up your total capital gains or losses from each period, you add them together, and then this gives you the amount on line 21. And then 50% of that is either your taxable gain or a net capital loss. And again, only the net taxable capital gain will appear on the tax return. All right. There we go. Right, you guys holding up? Was that all clear? Clear enough anyway? Okay. As I say, we're only going to be looking at relatively simple examples in this course. The only capital gains you're going to be dealing with are capital gains that are reported on a T3 or a T5 and so forth. So only capital gains from slips